There's a fund most investors ignore completely, and it's been crushing the market for decades. Not a hedge fund, not some secret Wall Street product, something hiding in plain sight. By the end of this video, the real reason most people never find it will make complete sense. Every year, millions of investors pour money into the same popular funds, chasing the same headlines. Meanwhile, one category of fund sits quietly, unloved, underowned, and consistently outperforming. Here's what's wild. Financial advisors rarely recommend it. The financial media barely covers it. And that silence is exactly why it keeps winning. No hype means no flood of money chasing returns. To understand what this fund is, start with why investors pick funds in the first place. Most people choose funds based on recent performance. Whatever went up last year looks most attractive. This is called performance chasing, and research consistently shows it destroys long-term wealth. Investors pile in at the top and panic sell at the bottom, locking in losses every single time. The fund nobody wants doesn't have exciting headlines. It doesn't have a celebrity manager. It has something better, a structural advantage most investors don't even know to look for. That fund is the Small Cap Value Index Fund. And here's why it's spent decades beating the crowd. Small cap means companies with smaller market sizes, not tiny startups, but not household names either. Value means these companies trade at low prices relative to what they're actually worth underneath. Put those two together and something powerful happens. A return premium that's lasted for generations. Academics have studied this premium for decades. It shows up in market data going back nearly a century. Eugene Fama and Kenneth French, two of the most respected names in finance, documented it rigorously. Their research showed that small-cap value stocks tend to outperform large-cap growth over long periods. Not every single year, but across full market cycles, the premium has proven remarkably durable. Here's where most people stop reading, because this is the part that sounds uncomfortable. Small-cap value funds have stretches, sometimes years, where they badly lag the popular indexes. During those stretches, investors bail. They sell. They move money into whatever is winning right now. And the moment they leave is almost always the moment the premium starts paying off again. This is why the fund nobody wants keeps winning. Most investors can't survive the wait. The premium exists precisely because holding it is uncomfortable. Discomfort is the price of admission. But here's the part that changes everything. Understand why this premium exists, and it becomes easier to hold. Small-cap value companies are genuinely riskier. They have less cash, less brand recognition, less cushion. Markets price that risk in, which means buyers get a discount, and discounts compound into higher returns. It's not magic. It's compensation for owning what other people don't want to own. Simple as that. Now, most people watching this video have money sitting in a plain, large-cap index fund right now. That's not a bad place to be, but it means the portfolio is heavily tilted toward expensive growth stocks. Large-cap growth stocks, think the biggest technology companies, have dominated the last decade. But history shows no single factor dominates forever. Leadership always rotates, usually when least expected. This is the moment in the video where the real question hits. What does an investor actually do with this? The answer isn't to dump everything and go all in on small cap value. That defeats the purpose entirely. The goal is a tilt, adding small cap value exposure on top of a diversified core portfolio. A tilt means the portfolio bends toward the premium without betting everything on a single factor. Think of it like seasoning. A little changes the flavor of the whole meal without overwhelming it. Many investors who use this approach allocate somewhere between 10 and 30% to small cap value. The exact percentage depends on risk tolerance, time horizon, and how much volatility a person can stomach. Longer time horizons tolerate more tilt. A 20-year investor can ride out the uncomfortable stretches. Someone retiring in 3 years probably doesn't want to add significant small-cap value exposure right now. Now here's the part most people don't know. Not all small-cap value funds are created equal. Some funds call themselves small-cap value, but hold stocks that barely qualify as either small or value. This is called index dilution. The fund waters down the factor so much, the premium nearly disappears. The real thing to look for is a fund with deep factor exposure, maximum tilt toward true small-cap value. Dimensional fund advisors, often called DFA, built their entire business around pure factor investing. For years, DFA funds were only available through certain financial advisors, not directly to the public. That exclusivity added to the fund nobody wants reputation. Most investors didn't even know it existed. Today, DFA offers ETF versions that any investor can buy through a standard brokerage account. Avantis is another firm that has built highly regarded small-cap value ETFs with deep factor exposure. Even Vanguard and iShares offer small-cap value index funds, broader but still carrying the premium. The choice between them comes down to how purely an investor wants to target the small-cap value factor. Deeper factor exposure historically means higher potential returns and also higher potential volatility. Fees matter too. Every dollar paid in expenses is a dollar that can't compound inside the portfolio. Small-cap value funds generally carry slightly higher expense ratios than a plain total market index fund. But if the premium is real and durable, that small extra cost should be dwarfed by the return difference. Now, the midpoint reveal. Here's the real reason this premium has survived for so long, despite everyone knowing. Knowing a premium exists doesn't make it easy to capture. The behavior gap destroys theoretical returns. Studies show real investor returns consistently lag fund returns because of buying and selling at wrong times. Small cap value amplifies this problem because its bad stretches feel worse than a plain index fund's dips. An investor who understands why the fund suffers is more likely to hold and actually capture the premium. That's the edge. Not a smarter algorithm, not insider access, just understanding and holding through pain. One practical tool for surviving those stretches is automating contributions, regular monthly purchases. Automation means buying happens whether the fund is up or down, removing emotion from the equation entirely. Dollar cost averaging into a small cap value fund turns volatile periods into discounted buying opportunities. Another tool is rebalancing, trimming what's grown too large and adding to what's fallen behind. Rebalancing enforces the discipline of buying low and selling high automatically, without emotional decisions. Combined, automation and rebalancing form a system that does the behavioral work for the investor. Now, the question that always comes up is the small cap value premium still alive today? Fair question. Growth stocks dominated the last decade so thoroughly that many declared value investing dead. But value's death has been declared before, multiple times, and it has come back stronger each time. The academic research on factor premiums hasn't changed. Human behavior hasn't changed. The math still holds. What has changed is the valuation spread. Small cap value stocks look attractively priced relative to growth today. A wide valuation spread has historically preceded strong small cap value outperformance going forward. That doesn't mean it happens tomorrow. It means the setup is in place and patient investors benefit most. Here's something else most people don't know. Small cap value exposure can live inside a retirement account. Using a 401k or IRA to hold small cap value funds means no taxes on the growth while it compounds. The IRS gives that shelter. An investor who ignores it pays taxes that the math never anticipated. Check the fund options inside the employer plan. Many 401k plans now include a small cap value option. If the plan doesn't offer one, an IRA opened separately gives complete flexibility to pick the best fund. Putting it all together, here's the complete picture of what makes this strategy actually work in practice. Start with a diversified core, total market, or a broad index to anchor the portfolio with stability. Add a meaningful tilt towards small cap value, enough to matter, not so much it dominates the portfolio. Choose a fund with deep factor exposure and reasonable fees, not just the one with the best recent return. Automate monthly contributions so the investing happens without emotional interference every single month. Rebalance once or twice a year. It keeps the tilt meaningful and forces the buy-low behavior automatically. And then it hold through the years when the fund lags, through the stretches that feel like a mistake. Because here's the thing, the investors who held through every uncomfortable stretch are the ones who won. The fund nobody wants doesn't reward cleverness. It rewards the one thing most people refuse to do. Wait. Most investors will read about this premium nod and go right back to chasing last year's winners. The few who act, who tilt, hold, and rebalance, are collecting the premium that the crowd keeps leaving behind. That's the fund nobody wants, and it has been crushing the market for nearly a century.